Our next guest sees signs the rally may hit a pause. Let's bring in Savita Subramanian, head of U.S. equity and quantitative strategy at Bank of America. Savita, great to have you with us. What's going to cause this pause in your view? Is it that we are stretched on valuation? Is it going to be fiscal stimulus not coming in as strong as the market wants?
Yeah, I mean, I think it's a combination. But here's, I think, the big risk is the idea that fiscal stimulus has been aggressive. Fed stimulus has been aggressive. Reopening is starting to happen, but is, fraught with risks of a second wave. And now, in order to really get through this, we need to see either continued momentum in that recovery story, or if there is a stall, we just need more stimulus to keep this story going. So I worry that, if you think about it, we've seen as much stimulus over the last few months as we've seen throughout the entire last 10 years. And we still haven't cleared the prior market high. So I think that those are the things we need to think about, is what's kept this bull market going. It hasn't really been cyclicals recovering on optimism around reopening. It's really been more about stimulus and liquidity looking for a home and finding it in FANG stocks. Mm-hmm. So you know what, the number one thing that worries me about the S&P 500 today, and this has really been a boon, is that almost half of it is technology. If you look at the tech sector, communication services, plus online and internet retail, that's almost 50% of the market is tech. So, we really need more stimulus to keep this going. I think, at the end of the day, that's probably a longer term positive because tech is the future. But, one of the things I worry about is that if we do see a rotation towards some of the more beaten down cyclical areas of the market, what happens to tech? Is that used as a source of funds for getting long other areas of the market? So it's a little bit of an environment where good news could actually be bad news for the S&P 500, which is much more exposed to some of those secular growth and technology themes.
In terms of technology, Savita,
on top of that,
sorry to interrupt, are these valuations stretched here? Because I see that on your screener it comes up as number 2. And so I'm wondering how that meshes with this notion that perhaps we're at a point where some valuations are high.
Yeah, so valuation on tech right now, if you look at, if you just looked at a simple kind of growth versus value breakdown of the market, growth is actually trading, and growth is basically tech and internet retail and some of the work from home beneficiaries. These stocks are basically trading at higher multiples than what we saw during the tech bubble. So on price to book, we're at levels of optimism on growth stocks that we haven't seen ever. And I think the question now is, how do you value these stocks in a zero interest rate, free money environment? And the talk that I hear around, we need a new valuation measure for tech companies, really reminds me of another period in time, late 99, early 2000, where we were trying to value these companies on price to eyeballs, and then we all know what happened after that. So there's a lot of, I think there are risks to technology stocks. The things that keep it going are they still have good balance sheets, they still have better growth than most other parts of the market. But I think to one of the other commentators' points, if we see anything kind of even remotely positive around a reopening and a cessation of this second wave risk, that could really bolster a lot of these dollar stocks in the market that are trading near bankruptcy levels, like the traditional retailers, et cetera.
Right.
So that's what worries me a little bit about the S&P in particular.
Tim, you have a question?
Yeah, hey, Savita, thanks for joining us. I saw your notes and you talked a little bit about where the equity risk premium, no matter what, it makes this a very interesting time. So we're probably in excess of a dividend yield on the S&P even after cuts of more than 3 times the 10-year. How much do you think that is supporting equity allocation right now?
I think that is the number one reason that there's a bid on the market, is that it's got income. Everybody wants income. Income on the S&P is a whopping multiple, close to a record high multiple of what you're getting in other fixed income assets. So as long as that continues, maybe you continue to see inflows into stocks from bonds and other areas. But, again, think about it. We've had a period where individual investors, hedge funds, institutional investors have moved capital into the market. We're close to all-time highs. Yeah, the yield aspect is still a strong story. So I guess my advice to investors is look for companies that offer safe, sustainable yield that still provides a much higher level than what you're getting from traditional fixed income. But beyond that, I don't know if the market itself has a lot of room to move a lot higher from here. The other thing I worry about is, we're at a point where the next 3 months historically have seen very significant pickups in volatility. So we're 3 months away from a presidential election. If you look at the VIX or realized volatility in the 3 months heading into a presidential election, usually you see about a 30% increase in the VIX, which, as we all know, is negatively correlated with the market. So another risk to equities from here is we're moving into this period where you've typically seen a demonstrable pickup in volatility. Not a lot of cheerful things to say right now about the market, sorry.
Yeah, thanks, Savita. No, but it's always good to see you. Thank you so much, Savita Subramanian of BofA. Steve Grasso, I'm glad that Savita mentioned this sort of seasonality, and I really don't like seasonality as a notion in general because I feel like people know what the seasonality is, and so people sort of front run that seasonality. But muscle memory is that in the fall, bad things happen in the markets. And we have seen that time and time again. So we have that sort of, underlying reaction to October, let's say. And then you have the presidential elections in November.
Yeah, I think everyone's setting up for an extremely volatile. You got to remember the economy is going to be starting up. You have schools that may or may not start. It's going to be extremely volatile. The biggest thing that the market has to worry about is large cap tech and tech. As she said, it's 50% of the market. If that rolls over, the market rolls.